Hello and welcome to Market Domination. I'm Julie Hyman alongside Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
Right, here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Yes, I do think we're going to get a rate cut. Actually, I think we might end up with two, possibly first in September and then the second in December. And no, September is not too close to the election. So there is still the possibility that the Fed will try to let us know that they are apolitical and do what they think is right for the economy.
For independent shareholders, based on all the press reports, I think it's pretty clear that the Sony and Apollo bid is the best possible outcome. But of course, there's still lots of uncertainty here, and there's still a controlling shareholder in terms of which direction that she's going to choose to go.
Kicking off our coverage of Milken Institute's global conference today with discussions on everything from AI to geopolitics.
I think we've had a soft landing. When rates have gone up 400 basis points and the wheels haven't come off the bus, as they say, I think that's the definition of a soft landing. Will it continue? I think so.
We've got 1 hour to go until the market close, and let's take a look at the major averages sponsored by Tasty Trade. We've had a little bit of volatility today within a relatively narrow range. Right now, the Dow up about 94 points or so, about 1/4%. The S&P 500 up about 3/4%, and the Nasdaq gaining the most today, about 0.9%. What's caught my eye today is that a lot of investors seem to be looking forward, and that's evident from the Yahoo Finance trending ticker page, because the top trending ticker pretty consistently throughout the day has been Palantir, which reports its earnings after the close of trading. Of course, we'll be all over those numbers, but right now the shares are up 7% ahead of that. Another in that category is Disney, which reports tomorrow before the open. Those shares are up about 2%. So it just shows again that folks are looking forward. One more trending ticker that I do want to mention here is Robinhood. That's after the company revealed it got a so-called Wells notice from the SEC, the Securities and Exchange Commission, that could be a prelude to some kind of action against the company. We are going to dig much more into that later on with an analyst. The shares have been bouncing around all day. Right now, down 1.4%. Getting back to the broad averages, though, do want to touch on what we're seeing sector-wise here with this rally going on. The weakest groups today, consumer discretionary and real estate. The strongest, we've got communication services stocks doing well today, financials higher, and energy also gaining some steam. We are going to dig more deeply into the energy trade or the oil trade, what's going on today, a little bit later in the show. But quick survey of the Nasdaq 100 as well today, since that communication services group is up strongly. Meta, a big part of that, it's up 2.7%. And I also want to highlight what's happening with NVIDIA today. Another one on our trending ticker list. This one isn't even reporting this week. It's not reporting until the 22nd of the month, but the shares are up 3.6% today. It'll be the last of the Mag 7 to report its numbers. Josh?
All right, Julia, the latest jobs report showing the labor market cooling in April. Hiring and wage growth slowed more than economists were expecting. Our next guest thinks the Fed may end up cutting rates, not because of inflation, but because of a weakening labor market. For more, we're bringing in now Brian Nick, Chief Investment Strategist at the Macro Institute. Brian, it's good to see you.
You too. Thanks for having me.
So maybe just to start, Brian, you look around right now at these markets and decent economy, decent earnings. It sounds like, Jay Powell basically just took at least a hike off the table. It sounds pretty constructive, doesn't it?
The question is, are we sort of decelerating toward that soft landing, or are we going to pass through the soft landing onto our way to something worse? And I think it's too soon for us to say for sure what's going to happen. Interest rates are still very high. We're still seeing that bite a lot. The SLOOS survey just came out showing that more banks were continuing to tighten lending standards. A little bit surprised that we didn't see a continued tick down in the number of banks that are reporting tightening lending standards for businesses. For consumers, more consumers feel distressed. There's more delinquencies happening. We'll get an update on that report from the Fed next week. That tends to be a time where you mentioned consumer discretionary underperforming. That tends to be a moment where consumer discretionary tends to underperform as we start to see cracks in the labor market, some cracks in the housing market potentially, and that both leading sort of downstream towards a weaker consumer. So that's our concern as we move forward into the second half of the year.
You know, we've been talking for so long about landings. refresh our definitions. What is a hard landing? What is a soft landing? Because, and I don't think the definitions are sort of hard and fast.
Right.
So I guess in your view, what would constitute a soft versus a hard landing versus a no landing or whatever else we're calling it?
Hard landing for us would just mean we end this in a recession. Whether the Fed cuts rates in June, July, or doesn't go until November, December, if we end up in a recession, that's a hard landing. It means we're going to get probably another 1% to a 2% increase in the unemployment rate. That would be sort of your classic definition. Soft landing, again, a little bit of a slippery definition, but I would say if you're looking at the potential for the Fed to start cutting interest rates without a material increase in the unemployment rate. The only time we've really seen that is in 1994 and 1995, so it's been a while. Most investors have not seen one in their sort of investing lifetime at this point. So it's been elusive, and one of the reasons is because interest rates tend to have this long and not so variable effect on the economy. So the tightening that the Fed was doing 2 years ago is still with us today, and the tightening the Fed continued to do over the summer of 22 into last year is still coming online. And they're just this morning, I think President Barkin from the Fed said he still thinks that we are yet to see the full impact of higher rates on the economy.
Are you still, Brian, though, is your house view still you're counting on cuts this year?
We are, because we think that the unemployment rate is going to move up uncomfortably high for the Fed.
When would you, are you September, December? When do you think you'd see the first cut?
So if you look at some of the leading indicators for unemployment, NFIB surveys, things that tell us that probably the unemployment picture is going to start to get worse in July, August, September. So if the Fed doesn't cut in late July, which is that last meeting of the summer, you'd be looking into September. But I think by that time, we could be seeing not only Fed cutting rates, but also cutting rates potentially by more than 25 basis points at a time if they're cutting because of the unemployment situation getting worse, not just because they are satisfied with inflation.
What's uncomfortably high?
Their forecast for the end of the year is 4%. We're at 3.9 right now. So it doesn't have to go much higher. And
I see. So in their view, uncomfortably high, even if it's not much worse than it is now.
He said he would tolerate a few tenths higher than it was 3.8 when he did his press conference. So I'm thinking by the time we get to 4.25, certainly anything approaching 4.5, the Fed's going to be in sort of 5-alarm fire mode.
This scenario that you're painting has become sort of out of consensus, I think it's safe to say. What is the rest of your cohort missing that you are seeing that you think indicates this path?
I think the first is that there's this sense that we've already seen the effect of higher interest rates, which we talked about a little bit earlier. But I think also if you look at some of the leading indicators for, say, the housing market, thing we thought was going to be meaningfully additive to growth, and it was in the first quarter, that's going to go away in the second quarter and third quarter because interest rates have stayed high. So restrictive policy is still biting. If people perceive the value of their homes is going down, they're going to behave more cautiously. If we don't see the equity market continue to make new highs, that's going to make people behave more cautiously. The wealth effect has a lot to do with this, as does people's comfort with the labor market. And that consumer confidence survey we got last week, the net percentage of people who feel like it's easy to get a job is continuing to tick down. What determines how much people are going to save versus spend? How confident do they feel about their jobs and how wealthy do they feel? That's been powering us through 22, 23. In 24, that's looking like a lot shakier case. So it's really the consumer and the downstream effect on the consumer from both the labor market getting a bit weaker and the housing market not being as strong as it was.
So given this view then, Brian, in the stock market, where do you want to be positioned? What sectors look attractive to you?
Well, we like the defensive sectors, but nobody ever wants to hear that, right? Utilities, consumer staples, they're going to be your traditional sort of bond substitute. You want to target high quality companies, high profitability, high dividend yield. If you're looking within sectors, we're actually writing a report on consumer discretionary right now. Consumer services, believe it or not, that includes a lot of the cruise lines, the hotels, but that actually tends to perform relatively defensively within consumer discretionary. Didn't work in 2020. That was a very specific case where the economy shut down and people were not taking vacations. But for the most part, if you look at consumer confidence, when that's falling, services is outperforming. It's sort of a low beta defensive part of that sector. So if you want to get down into the details, consumer discretionary tends to do better when interest rates and inflation are falling, but not when the economy is falling apart. So it's hard to find those obvious targets when, other than looking at the bond market when things are getting worse.
Lastly, you mentioned utilities, and this is a little bit of a left turn, but I'm curious, there's all this talk about new AI power demand linked to that industry and what's happening. And so I wonder the effect that that's going to have on the utilities, but does it also, in a way, make them less defensive if they are so tied? Yes, you could argue it's a long-term secular growth story, but it's also presumably going to be somewhat cyclical as well.
Sure, I just was reading this morning that
Sorry, that was a lot.
Question. There's less demand for sort of a lot of the residential multifamily real estate getting built up, but a lot of that real estate could potentially be taken up, and construction workers' time be taken up building data centers.
Right.
So exactly to your point, using more power and more land just physically taken up by servers that are needed to power the AI revolution if and when it gets here. That is potentially the case. The way that cash flows tend to work, though, if you're collecting rent and that rent is relatively locked in over time, it's the same thing as like owning like farmland, also tends to be a very defensive asset. Probably not quite the same with utilities, especially if they're tied more into the cyclical parts of the economy. But we know cycles evolve over time. Discretionary used to be very cyclical, and now it's very growth oriented because of the changing makeup. And the same thing is true with technology. Those now act more like defensive sectors than they did in the past. Utilities could be going potentially the other way.
Last question, Brian, for fixed income investors listening right now. What's your guidance? What's your advice?
We like extending duration. We like being defensive here. Again, that's not the most popular call. But if you look at spreads on corporate bonds, those have tightened quite a bit. The expectation that interest rates are going to fall has powered some of that. The longer they stay higher, the weaker the economy looks. You could see those spreads widen out. So if you want to be really defensive, you could be holding very short duration cash-like instruments with the yield curve still inverted. But we think you get more bang for your buck if our call on the recession is right by owning longer duration securities.
Good to see you, Brian. Thanks
You
for
too.
coming in.
Thanks for having me.
Well, Yahoo Finance is bringing you coverage of Milken Institute's global conference today. Geopolitics, AI, the U.S. election, they're among the topics on the docket for the week-long event. Yahoo Finance's executive editor Brian Sazi and our Akiko Fujita are in Los Angeles. Akiko, let's start with you. What are you hearing so far?
Yeah, Julie, as you can tell, we've got a lot of people out here. Hard to hear what we're talking about right now, but look, a lot of the conversation that I've been having is about geopolitics, but specifically about what is happening between U.S. and China. We heard from Kristalina Georgieva earlier today talking about industrial policy, the additional tariffs that could potentially come, what that means for the U.S. economy overall. And then we just had a conversation with the former Prime Minister of Australia, Kevin Rudd, talking about how this is likely to only increase further because of what's been playing out between the U.S. and China as well. Certainly in focus, given all the conversation around AI, especially and the competition that's playing out.
That's why I love being here with you, Akiko. You have that global focus. I'm going back to stocks. I mean, it's something that still excites me. We talked to Apollo CEO Mark Rowan, of course, Apollo, the parent company of Yahoo Finance, talking about how it may not be such a great idea that investors are so allocated to NVIDIA, Apple, Amazon, all those magnificent seven stocks. Heard the same moments ago from former Milwaukee Bucks owner Mark Lazary saying it's probably not a good idea. I'm going to put up an article soon on that. Actually, I'm going to make that our morning brief newsletter for tomorrow. Some more details about not investing in Mag 7 stocks. So, Julie, of course, all things stocks, business, global, you name it. A little bit of everything here at the Milken Conference.
And obviously, judging from the backdrop, lots of people to talk to. Thanks so much, guys. Appreciate it. Looking forward to much more from the conference. And coming up, speaking of which, we're bringing you plenty of coverage from the Milken Conference. We'll hear from the heads of ExxonMobil, IBM, and Pinterest. Plus, Robinhood shares lower after a new legal threat emerges from the SEC. How concerned should investors be? We've got more coming up. And we're kicking off Small Business Week with a panel of business owners. We'll have the latest from Main Street in the 4 p.m. hour.
Welcome back to Yahoo Finance's coverage of the Milken Conference at the Beverly Hills Hilton in California. And a big moment in the history of Exxon, having closed its Pioneer deal. Let's bring in Exxon Chair and CEO Darren Woods. Darren, good to see you again. Appreciate it.
Thanks for having me.
So, just closed that Pioneer deal. What should investors expect from an earnings power standpoint over the next couple of years?
Well, when we were looking at an acquisition, what we talked about was every opportunity has to deliver more value than what either company could do on its own. And what we found with Pioneer is an opportunity to take the technology, the development techniques that we've come up with in unconventional space, take Pioneer's understanding of the resource, the basin, and their acreage, and together put those two companies together, produce more oil at a lower cost, which is good for consumers, good for the economy, and do it in a more environmentally responsible way. We're taking their 2050 net zero pledge and converting it into a 2035 net zero plan. And so good for the U.S. economy, good for U.S. Consumers, good for U.S. energy security, and good for the environment. So a real opportunity to create unique value. We said at the time of the announcement that we would create on an annual $2 billion of synergies once we got up and running. My expectation is we'll do more than that.
You think this is the type of acquisition that causes a re-rating in Exxon stock?
I think it adds to what we believe is the unique value contribution that we can bring to this industry. We have been trying to help people understand that as a company that has an expertise and technology capabilities in transforming hydrogen and carbon molecules, can certainly continue to play an important role in our existing industries. But we've got huge opportunities in developing other materials that society needs that leverages the hydrogen and carbon molecule, that doesn't involve combustion, doesn't involve emissions, and we see a huge opportunity in that space for us.
The Permian Basin's obviously been the big opportunity for Exxon for decades, but you've really been touting the opportunity you see in Guyana. Can you help me understand, when you look at the overall pie, how significant that's going to be as a revenue driver?
So the way people often forget that our industry, the oil and gas production business, is one that continually declines because you've got every barrel you produce is a barrel that's not available tomorrow. And so the challenge in our industry is to continue to go out and find new resources to bring those online in production. And today's challenge is to do that in a low-cost way so that you have low cost of supply, but also do it with low carbon intensity. And so our developments have been very focused on finding those unique resources, bringing our unique capabilities to bear so that we create the best in industry supply source from a cost standpoint and from an emissions standpoint. Guyana is absolutely critical in that. It's critical not only for our company, but I would say it's critical for the people of Guyana. The value that we're bringing to Guyana, its government and its people with the jobs, the economic activity. I mean, their GDP is growing as fastest in the world right now, and this, in part due to this resource that we're developing.
I've heard you talk about low carbon a lot. Low carbon solutions, certainly sort of the big push ahead for ExxonMobil. Specifically on carbon removal and direct air capture. You've heard that holy grail number, $100 a ton, is where you need to get at to make this an impactful solution. What's the timeline for Exxon on that right now?
Well, I think it's very difficult to put a timeline on a technology breakthrough. What we recognize is we have a suite of technologies that historically have been used for different applications. We're now trying to repurpose those technologies to a much harder, much more important application, recognizing that today the carbon capture technology only works for the highest concentration streams of CO2. So we got to find a way to bring that cost down. The good news is there's a lot of technology, progress made in technology that haven't been applied to this space. And so we're, with our technology organization, looking at new materials, new opportunities to try to bring that cost down. And there are many other companies trying to do the same thing. And so our view is every company should be leaning into its areas of expertise, trying to crack that nut. Once that's solved, whoever solves that, we believe our company is going to play a critical role in deployment, because there are very few companies that have the ability to build large-scale facilities that convert molecules and can do that around the world. We have that capability as well as the technology. So some combination of those things will come together, and we'll keep moving down the path of decarbonizing the world.
How would you grade the regulatory environment under the Biden administration?
How would I grade it?
Grade it in terms of getting done what you need to get done.
So I think the Biden administration has come in and with a very clear objective of reducing emissions and trying to decarbonize society, which is a good thing. I think they've also been very cognizant of the balance that has to be struck between doing that and at the same time continuing to meet the needs of the people, providing reliable and affordable energy. I think the legislation, the IRA legislation that the Biden administration championed is important because it focuses on the objective, which is carbon intensity and reducing carbon intensity. What it's left open is how best to do that. And the value or the importance of that is it allows every company, every sector, all the technology organizations to focus in on how best to achieve that based on their capabilities, their skills, and their set of circumstances. And so it doesn't try to prescribe how to do something. Instead, it focuses on what must be achieved. I think that makes for good policy. That certainly opened the door for us to take the capabilities that we've developed over the last 140 years and apply that to this challenge of reducing emissions. And we think we have a really good opportunity to make a very large reduction in emissions with a very large investment, one that will move the needle.
You've been very vocal a lot more about the efforts that ExxonMobil's making to reduce emissions. It strikes me as a very cautious approach, and you've talked about being more disciplined, playing into your strengths, returning shareholder value. I wonder where climate science plays into all of it. You were just on a panel with John Podesta, the climate advisor, who said, look, we don't have the time to be moving slowly and cautiously. How do you think about that piece? Because at the end of the day, it is to address what scientists have called the climate crisis.
Well, I think there's I would separate the role of a company from a government. And if you want to dramatically reduce the amount of emissions happening today, you're going to have to abandon the systems, the energy systems that are in place today that are delivering that. That means people around the world are going to have to do without. And the people who are lower on the economic prosperity scale, developing countries, people who are still trying to make their way up the economic ladder, if they don't have affordable, reliable energy, they'll be penalized. That, in my definition, is not a just transition. And so balance is important. I don't think anybody's arguing about the need to reduce. The question is, how can we best achieve that reduction? And frankly, if you go back in time, we've been too narrowly focused on a very small segment of solutions. What we got to do is open the aperture and find every company's and industry's ability to reduce emissions and do it in a constructive way. And so I think the good news is that aperture is starting to open. We do see policymakers around the world recognizing that we're going to need more solutions, not fewer, and allowing those solutions to come in and play a role. I think that's the way we make progress the fastest.
Where is Exxon in 2050?
Well, we're going to still, I suspect, be producing oil and gas, depending on how quickly the world transitions. That may be a smaller part of the portfolio that it is today. But if you look at our core capabilities, the technology capabilities that we have, we can make a lot of other products that meet the needs of society. I'll just give you two very quick examples. We've tasked our technology organization to take the molecules that we're using today in existing applications and make something new that the world needs. So gasoline molecules that go into the gasoline transportation fuel, we've got a technology today that can take those same molecules, make a resin out of them, and replace rebar for construction. It's lighter, lower emissions, and more cost effective and doesn't corrode. So a brand new product to the world made out of gasoline molecules. Likewise, carbon dense streams in our refineries to use that to make carbon materials and to use them in batteries for electrifying cars, or using to make a new process to making carbon fiber. So ways to take these molecules and make new products that society needs in large and growing markets. So my view is we'll continue to leverage those core capabilities of transforming molecules, but the products that we make in 2050 may be very different than the products that we make today, but they'll still be relying on those key core capabilities that, frankly, this business has been built on, our company's been built on.
Well, thank you.
I was going to say, so oil and gas still part of the portfolio in 2050?
I think there's oil and gas that goes into combustion and emissions associated with that, and then there's oil and gas and the hydrocarbon molecules that go into products that people use every day in their lives. And my only point is, we've got to deal with the combustion and more specifically the emissions associated with combustion, but there's huge utility for the hydrogen carbon molecule and the products that society needs. So my view is you're going to continue to see those products, oil and gas, use it as, if nothing else, a feedstock to make products that society needs for modern living.
Thank you for always making time for Yahoo Finance. We appreciate it. Exxon Chair and CEO Darren Woods, enjoy the rest of the conference.
Thank you. Thank you.
Julie and Josh, back to you.
Thank you so much, guys. Really interesting stuff there from the Exxon CEO. And let's stick with oil right now because prices are edging higher as Saudi Arabia hikes June crude prices for most regions. Traders are also digesting the confusion regarding reports over a potential ceasefire in Gaza. Here with the details, Yahoo Finance's Inez Ferre. Hi, Inez. How you doing?
Hi, Julie. Yeah, and we did see some confusion in the markets early today as you saw conflicting headlines. One that Hamas had agreed to a ceasefire, that being told to Al Jazeera. The other one then Israel saying that it did not agree to a ceasefire through Reuters. So this is where you saw that confusion and the markets briefly turned negative around early this afternoon right there. Now, you are still seeing, though, WTI up for the day, up more than 0.5%. Brent crude also higher. Part of this has to do with the expectations of perhaps a ceasefire not coming as soon as the market had anticipated. Also, Saudi Arabia, Saudi Aramco, increasing its crude prices for customers across Asia for the third consecutive month. So that is signaling a tightness in supply. And that sent Brent, the international benchmark price, higher. OPEC Plus will be meeting at the beginning of June. And the expectation is that the Oil Alliance will be continuing with its production cuts. You do have some analysts that are saying, well, perhaps they will increase capacity because the alliance doesn't want the U.S. and other countries to increase their market share. But nonetheless, you are seeing that oil last week retreated back more than 6%. You really saw that unwinding of the geopolitical risk. If you see that geopolitical risk winding back up again, then you are likely to see oil prices higher. But you have analysts that are calling for oil in the second half of the year, Brent, to be averaging around $85 per barrel. Right now, you're looking at Brent that's around the $83 mark. Guys?
All right, Nez, thank you so much. Appreciate it. Time now for some of the day's trending ticker. Shares of Tyson dropping after reporting second quarter earnings. The company's sales falling short of analyst expectations, and executives saying that the third quarter could be weaker than the fourth. For more on Tyson, we're bringing in Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon, Josh. Good afternoon, Julie. I mean, certainly what investors were weighing on was that weaker Q3 guidance here. Shares dropping as much as 9% during today's trading session, as the company did point to that weaker Q3 guidance. Now, one of the influences on that weaker than expected guidance was basically because of the state of the consumer and what Tyson is seeing right now. And Tyson CEO Donnie King did tell Yahoo Finance that the consumer is experiencing inflation for housing or utilities, for virtually everything in the economy. And one that is really concerning is around consumer debt. This consumer is a little bit under pressure, he said. Now, that consumer being under pressure is just one of the factors that led them to weaker guidance for Q3, ultimately leading to what they said is a consumer bifurcation, with consumers moving from fine dining to casual dining to QSR, but then others in the lower income cohort then turning to food services, or ultimately then deciding that they're going to cook at home. Other factors leading to that weaker Q3 guidance include limited cattle availability, higher commodity costs, and pork and prepared food seasonality here. Those are just some of the uncertainties that Donnie had laid out to us in a call. But ultimately, he did say that weaker is just a little bit weaker. He said that we maybe have overcooked what exactly that weaker guidance could look like, and they do expect Q4 and the fiscal year to shape up to be pretty good overall. But Wall Street being quite critical of this. I did speak to CFRA analyst Arun Sundaram, and he said that typically Q3 should be a strong quarter because of the grilling season and the demand that the company typically sees there. And so Wall Street definitely responding to that comment on the call today.
Yeah, for sure. Thank you, Brooke. Moving on, shares of Spirit Airlines slipping after announcing Q1 earnings. The company missed second quarter revenue guidance expectations, and the CEO saying the competitive environment remains challenging. So this one, Julie, the stock actually hit an intraday record low in today's trade. The issue here, the revenue guidance missed. Looks like the adjusted operating margin guidance also kind of missed consensus as well. Team at Citi saying, and they rate this one a sell, but they tell their clients about the results. These kind of already didn't really bring many surprises, but the guide was weak. And the carriers stating, they said that it would need to see more improvements in off-peak demand in order to meet its forecast. I also point out the carrier high overcapacity in some markets, Florida and Latin America among them.
Yeah, average fare per passenger down 16% in the first quarter compared with a year earlier. And I didn't realize this because of everything that's been going on with Boeing, which, by the way, we'll speak about in a moment. But Spirit actually had some issues with some Raytheon or RTX Pratt & Whitney geared turbofan engines, which had grounded some of its aircraft. So that was an issue for it. Remember, they furloughed some pilots in September. They're trying to cut costs, but the street is not satisfied here. Something else to keep in mind here is the company's debt position. It's having some discussions with its bondholders to try to resolve, whether it's going to be able to, I guess, repay some of its debt. So that's something else that analysts are paying close attention to right now. And those discussions, I think, are supposed to resolve by the summer.
All right.
And speaking of Boeing, which I mentioned here, we are watching those shares as well. Federal air safety regulators are reportedly opening a new investigation now, which is aimed at looking into the company's inspections of its 787 Dreamliners here. Again, this is the latest that we've got here, and a new investigation. Apparently, the FAA said that the Boeing notified it in April that it might not have done required inspections related to some of the safeguards of where wings join the fuselage of certain aircraft. This is according to the Wall Street Journal. Also, we should mention our Alexis Keenan reached out to the company, and Boeing said once it realized this issue, it promptly notified the FAA, and this is not an immediate safety of flight issue for the planes that are in the sky today that are flying.
Yeah, that was what you immediately think of.
Yes.
Does it mean the 787 Dreamliners need to be pulled out of service? The Journal, who broke this story saying it's not clear right now, they do, though, cite this Boeing program chief, who I guess an internal message, Julie, last month had said, the company had found no immediate problems for Dreamliners currently flying. But, as you kind of highlighted there, it's another headline and another quality issue here that Boeing doesn't need.
Right. The shares are down some.
Yep.
But it's not as it's not as though the market is having a huge reaction to this latest.
We'll keep watching. Coming up, Robinhood has received a warning from the SEC regarding its crypto business. Going to speak to an analyst on the other side about what this means for the trading platform.
Robinhood has said it's received an SEC warning that the trading platform could face an enforcement action related to its U.S. crypto business. Shares are lower right now, although they've been bouncing around, but there are some concerns. One analyst, though, says the news may be a little overblown. That analyst is Dan Dolev, Mizuho America's senior financial technology analyst. Dan, it's good to see you. As I mentioned, the shares have been bouncing around here. Now, typically, news comes out about what's called a Wells notice from the Securities and Exchange Commission, and a stock goes down because it's usually seen as bad news. Now, the stock was higher earlier, now it's lower, but why should people not be alarmed in your view?
Hey, thanks for having me. Typically, yes, not in crypto. In crypto, everything is different.
They're used to it.
We're used to it, exactly. Good news is bad news. No, but to be, the reason the stock is actually not going down, and the reason we say there's no reason to be worried, is because this is not new news. As far back as 2 years ago, if you go back to their 10K, the annual report, they've said that they've been subpoenaed by the SEC for some of these issues. So basically, the SEC has decided to take action on something that they've been calling out like 2 years ago. So this has been in the making. If you look at the exposure of Robinhood to crypto, it's only like 7% of revenue and like 15% of assets under custody. And, those tokens, ex Bitcoin, ex Ether, ex Dogecoin, the exposure is very minimal. And last, the reaction on Coinbase, Coinbase tripled since the Wells notice last year. So, the market clearly, is shrugging it off, so to say. So we're saying there's no real reason to be worried.
And Dan, do you have a sense of sort of timeline here? What happens next?
Look, I'm not a legal expert, but from looking at some of the other stuff around there, like Kraken and some of the other exchanges, I think that at worst case scenario, it's probably, again, this is just speaking of the layman, it's because it looks like it's not new news, and I'm looking at some prior cases. There could be like some sort of like a settlement or something. I don't see this as being, and the market's clearly agreeing with that. So timeline, this could take a little while, but I think the results, the fundamentals of Robinhood are so good that I think this is going to remain as a little bug bite, not more than that.
When you look at a situation like that with Coinbase, which has a much more combative, or sort of at least publicly combative, relationship with the SEC and with regulators, do you think Robinhood has sort of had the advantage of sort of almost drafting behind Coinbase to some extent, right? Let Coinbase fight the fight, and we'll kind of do our own thing here. So in that sense, also, is the Wells notice more of a sort of unexpected?
It's actually a great point that you're making, because they've been the good guy. Robinhood has been the good guy, and I think they, voluntarily since day one agreed to, not play in those, let's say, riskier tokens, right, that could be considered securities, and said we're staying in the, things that are considered commodities, like, Bitcoin or Dogecoin, whatever the SEC does not think is like a big risk. So I actually think that not fighting the SEC and being the good guy is going to help Robinhood in the long term, and not fighting it like Coinbase does.
And Dan, for Robinhood, earnings are on deck here Wednesday. What do you expect to hear?
So we think it's going to be a stellar quarter. We just published our preview today, just coincidence, like we didn't know this was coming, obviously. But I think consensus is, grossly understating revenues. There's going to be a massive, significant beat to revenues and margin. The best news you're going to hear, again, in my view, is you're going to hear a lot more MAUs, monthly average users, coming out of Europe, because this is kind of the surprise element, the traction they're getting in Europe, and all the success they're having in this Robinhood Gold, which is deposits coming in, gaining share from the likes of Schwab in terms of assets coming in from people because they're offering 3% match on your IRA. So a lot of these good things, they're going to start gaining scale this quarter, and it's going to be a phenomenal quarter with great guidance for the year.
Dan, good to see you. Thanks so much.
Thank you.
Coming up, our Milken Conference coverage continues. We'll hear from IBM CEO on the other side of the break. Stay tuned.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
You're talking AI, you have to also be talking IBM. Let's welcome in IBM CEO Arvind Krishna here at the Milken Conference. Good to see you again.
It's great to be here talking with Yahoo Finance and what a energy and buzz here on AI here at the Milken Conference.
All right, well, let's stay on that buzz, Arvind. How is IBM reinventing itself for this AI era?
Look, AI is a fundamental technological shift. We believe it'll cause $4 trillion of total value to the industry. Not all of that to the tech industry, but to the industry at large. All our clients want to tap into that. It's going to cause productivity, it's going to cause revenue gains, it's going to allow them to have more nimble enterprises. So what we are doing is building the AI that's good for the enterprise. Efficient, open source, in a way that our clients can control the IP and deploy it where they want. That's really what we're about.
You've talked a lot about that increase in productivity that's likely to come out of AI. Can you talk specifically in these early stages at least, how your clients are deploying Gen AI?
Absolutely. I think there's 3 use cases that really, I think, bring this to life for us. So if you think of contact centers, typically when people are doing customer experience, can you help that person become way more productive? So they might have to navigate amongst 3 or 4 screens. If you ever called a bank, you might notice the person on the other side is hesitating. They ask you, can you hold on for 30 seconds? Well, that's because they're looking something up. Could a generative AI step in and instantly get the information by querying the underlying myriad of systems? Can it make that person way more productive? By the way, productive means they get your query as an end user answered quicker, you're happier, you're more likely to get a correct answer. The AI never gets tired or angry or snippy or anything like that. I think that's a great use case. I think that's going to be endemic, everybody will use it. Second, coding. Making coders more productive. Everybody has tech debt. Can it help you get rid of the tech debt faster? Means that every enterprise is going to have more capabilities to offer their end users and their employees. I think these 2, without a doubt. The third one where we are seeing a lot, we call it digital labor. In these days of tight job markets, demographics that point to less and less people of working age, can I get a digital worker to augment the human worker? I think these are 3 great use cases. All our clients are interested in them. We ourselves use them as the first client, and it's giving us all of those benefits.
Warren Buffett at his annual meeting talked about how the AI genie is out of the bottle, and he sounded concerned. I love all those things. Please tell me my big bank balance without getting snippy with me. I get it. Are you concerned that AI will have too much power, and what are the risks from AI?
I actually have no such fear, so I'm putting it black and white. I think there's a lot of people who hypothesize, and as we have seen in many technologies, thinking that the rate of progress, which has been 100 times over the last 3-4 years, is going to be another 100 to 1,000 times. But just for the current AI, we need this much infrastructure and power for it to be 100 to 1,000 times. How much more infrastructure and power? I think it's a little, I use the term fantastical, to keep predicting that it carries on an exponential curve. I think it'll get widely deployed. I think billions of people will use it across hundreds of processes. That will happen. But to imagine it's going to reach this point of superintelligence, I'm a bit of a skeptic on that topic.
One of the big debates that's happening within the big players in AI is open source versus closed source. I know you're shaking your head because you're leading an alliance pushing for open source. For those who are not necessarily following closed source, we're talking about those like OpenAI, as well as Microsoft, Google. What is the risk of a closed source AI?
Yeah, so I think on any technology, for it to get that escape velocity, for it to really become ubiquitous, you got to balance between 3 things. Competition, you need competition, because as we all know, walled gardens tend to generally have very little innovation. So you need competition, innovation, but you do need some safety. As you think about those three, I think open source is a great way to achieve a balance on all 3 points. So open source is visible, everybody can look at it, you can red team it if you want to by yourself, you don't have to trust the vendor to do all of the red teaming. By the way, as we all know, AI is built on data. So in effect, the IP you're capturing is the data you're bringing. Open source means that somebody can take a model that we might provide, if they add their own data to it, they can keep it. We don't ask for it back. If it's proprietary, in effect, you get it back. So I think it allows for a much faster proliferation while giving transparency back to those who want to get scrutiny.
On that issue of transparency, there is a conversation about AI regulation. The U.S. has executive orders in place, but not necessarily a framework for a federal regulation. You've got Europe leading the way. You just had Japan's leader coming in, set up their own framework. Are you concerned about the U.S. falling behind in that conversation?
I'm not concerned about the U.S. falling behind. What I'm concerned about is that regulators should not regulate the technology. What regulators should regulate is the risk or the use cases. Can you imagine sitting back in 1995, let's regulate the internet. So let's regulate dial-up modems. How useful would that have been till today?
I may not have learned how to use the computer.
So I think that it's really to the point of Warren Buffett saying the genie's out of the bottle. Don't regulate the technology, because all you'll do is it'll go offshore. These are digital technologies. But regulate the use case so we are sure it's being used responsibly. One that I also talk about is make people who develop models accountable for what those models can do. I think those are tools that are classic policy tools and that can be wonderfully applied.
Opening up the black box, if you will.
Open up the box, let people innovate as fast as they can. Look at the last 18 months. How much innovation has come? There was OpenAI, then there was Mistral, now there's IBM. An 8 billion parameter model can do what our 200 billion parameter model can do. Let the innovation go. It'll make the technology cheaper and ubiquitous.
Marvin, it sounds like, just listening to you here, IBM is working on some really cool, impactful stuff on AI. Why do you think the valuation on IBM may not reflect or be on par with some other AI plays?
So I'm going to go cup half full and then address your question directly. First, I think we've had a pretty good run over the last 4 years. If I look at the last 4 years, I think we might have added 60 to 80 billion worth of total enterprise value. So I'd say that's good. Now, that does not meet our own aspirations, so let me acknowledge that point. But I think that as we begin to make progress, we've got to be more consistent in our overall revenue and cash flow performance. I think our cash flow performance has been pretty consistent, but we've probably got to be a bit more consistent on revenue performance. And as that happens, I think we'll get both the multiple re-rating, but also the growth that comes with underlying cash flow and earnings growth. So I think those are the two pieces. I'm very confident our strategy is in the right place. We're building, we're staying in the places that we have credibility, we work with the enterprise, hybrid cloud, AI, and quantum down the road. And by the way, I don't think quantum or AI is really fully priced into where we are, but I'll acknowledge, quantum is still 3 to 5 years out, and AI is kind of in the early innings. I use a baseball analogy. AI is kind of in the first innings of a game, don't quite know how it'll go. Cloud is more like the 5th or 6th inning. So you have a pretty good idea. Not over yet, but a pretty good idea.
Yeah, we like sports analogies here, right? Let's finally talk about sort of bigger picture. You've got a good pulse on where the economy is given just the scale of your client base. On your recent earnings call, you talked about sort of a pullback in discretionary spending. How, is that a pause? Is that a dry up? How would you characterize where that is? What does that tell you about the investments companies are willing to make, particularly in technology right now?
So I'm not an economist, I'm a businessman and an engineer, let me acknowledge that. But I see where my clients are spending and not spending. So I think that what is happening is really down to one reason. And I'm actually quite optimistic about both the US and the global economy, and I'll come back to that. However, interest rates are higher for longer than most people supposed in the middle of last year. So as you take that into account, if interest rates are 2-3% higher for the 5 and 10 year, then people have thought, that means that all of the debt is going to carry an extra price. So I think CFOs are belt tightening against that. Now, that's not systemic, that's not really secular, but it is a trend that's going to be there for a year or two, if that makes any sense. I think that's the belt tightening. If I look at anybody who carries tens of billions of debt, an extra 2 to 3 points is going to cost you an extra few $100 million per year. Okay, let's look after what discretionary spend. Let's not do anything catastrophic. Let's not make long-term decisions, but you go belt-tighten against discretionary projects. That's going on. Now, if I then look at demographic trends, I look at inflation trends, supply chain, cyber, all of that leads to, well, let's spend more on technology. So that's where you kind of see, I want more software, I want more infrastructure, I want more AI, I want more cloud, but if I can, I'll kind of tighten on labor-based services. I think that's the two speeds we are seeing, and we see that in the chart ourselves. Software grew well over 6% in the first quarter, and consulting was down 2 at constant currency, flat at actuals. So we see that in our own business, and I think it's a reflection of this macroeconomic trend.
Well, I wish we had some more time with you, but we don't. You're a busy guy. Like you're very in demand at this conference. IBM CEO Arvind Krishna, thank you for making time for Yahoo Finance. We really appreciate it.
Pleasure to be here with you guys.
There is the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today, sponsored by Tasty Trade. First, I'm going to start with where the major averages ended up here. We saw the Dow gaining about 176 points here after kind of bouncing around during the session, ending closer to the highs than to the lows. The S&P 500 moving up by 1% here, and also moving, if you look at a little bit of a longer chart, we don't have the 50-day moving average on here, but I can tell you we moved above the 50-day moving average, which is a technical indicator that I'm sure Jared knows a lot more about than I do. And then we had the Nasdaq leading the gains on the day, up by about 1.2%. 2%. Quick check as well while we're looking sort of broadly here at what happened with the 10-year. A little bit of a pullback today, but essentially flat at right around 4.5%. Jared now has a closer look at today's action.
Spot on with that 50-day moving average. We are now above it in all the major indices, plus the Russell 2000. You'll just have to take our word for it. Now, in terms of sectors, communication services, number one, that's XLC, houses Alphabet and Meta, as well as Verizon and some other interesting companies, Netflix. But then financials, tech, and consumer discretionary round out the top four. So it is a mega cap sectors plus financials. And let's take a look inside the Nasdaq 100, where we can see only Apple kind of taking things down a little bit of a notch. That's down 0.9%, but Nvidia up almost 4%, Meta up 3%, Alphabet 0.5%, and not a lot of losers here. It looks like Amgen down 3.79% down here. That is the biggest loser. We covered sectors, but I do want to take a look at some of our leaders. And ARC is the biggest winner here, up over 2%. And if we take a look inside the disruption field, unprofitable tech, we can see besides Tesla, a lot of strength here. Shopify up almost 4%, Square Block up 5%, DraftKings up 5%. Now, if we're taking a look inside tech, we also got to take a look at software versus semis. Here's software, a lot of green, but not too much dark green. Here's semis. We're seeing some more dark green. So semiconductors actually outperforming software within the tech sphere. And here you can see ARM up about 5%, AMD up 3%, NVIDIA up almost 4%. I think we've been there. I also want to show you one more thing here. This is meme stocks. And in a day where we're not seeing some of the fringier assets like Bitcoin rise, we are seeing meme stocks. So that, in addition to unprofitable tech, that would be the ARC components, just showing you that there is some interest in the fringier parts of the market. Palantir is going to be an earnings story this week. That is up 8%. American Airlines also up over 5%. Julie?
Thanks so much. Appreciate it. Jared. Yeah. Stocks closing out today in the green, building on Friday's upward momentum after a Goldilocks jobs report bolstered rate cut optimism. Joining us with today's top market takeaways, Josh Schaefer, as we're on a little bit of a streak here.
Yeah, it's the best 3-day streak for the S&P 500 that we've had in 2024. And I think perhaps just the broadest takeaway from that would be we had a bit of a gut check over the last month. We talked a lot in April about how we had our first down month since last fall. All of these headwinds seem to be mounting all at once like they always do. We have these inflation concerns coming. Maybe we aren't going to get rate cuts at all this year. What if Powell talks about a rate hike? And then last week, kind of seemed to be the moment where a lot of those concerns got cooled, at least for now. Powell said no to considering a rate hike as the most likely scenario next. We get that jobs report. Wages actually come in softer than people expected. That cools a little bit of your inflation concerns. And it really sets us up for what I put down as our second takeaway here, which is a quiet week of economic data. And I think a quiet week of economic data is just a welcome thing for this market right now when we've spent so much time over the last month talking about a rise in the 10-year yield. We're often talking about eco data releases at 8:30 that are driving that move in the 10-year. We're talking about Fed speak and what Powell is saying and what he's going to say at the upcoming meeting. And that was not something that we're going to have this week. So it seems like generally just a little bit of a quieter week as far as eco macro drivers. And maybe that's a good thing when earnings are actually coming in quite good.
Maybe it is a little bit of a pause for people to.
Yeah, a little bit of a pause. And normally stocks do better in weeks where we don't have eco data releases. So Bank of America.
Interesting. I didn't know that.
Bank of America had an interesting chart on this morning saying that the S&P 500 in a week where there is 0 major economic data releases. So you can see there when we say major economic data releases, we're talking GDP, CPI, a Fed meeting, jobs report. When there's none of those, the S&P is up by a median of 0.6%. And then you can see going across your screen there, the more events we have, usually the tougher it is for markets. So perhaps a quiet week means we can just drift a little bit higher for a little bit, because when you think about things that sort of test this rally, if I had to circle them on a calendar right now for this week, I couldn't name them, right? That doesn't mean they're not going to come. They always come out of nowhere, right? And can come out of nowhere. But right now on the calendar, it's not like we're waiting for a jobs report on Friday, an inflation print, but we will be next week. So for now, quiet on the economic data front for now.
Yeah, and I mean, and even the earnings front, we have some earnings, but none of them are hugely, sort of macro market moving.
Yeah, they'll be interesting on their individual sides, right? Like Palantir's interesting for the AI story, but does it really tell you anything about the overall AI trade? I don't know. We could debate that, but probably not, right? I'm excited to hear from Disney. It's going to be a very interesting report, but
it's really a Disney story.
It's a Disney story. So I don't really know. I agree. I think at this point, we're through 80% of S&P 500 earnings, and you have 5% earnings.
So then is it, Josh, like is it, well, if you think, okay, decent economy, decent earnings.
Yeah.
Jay Powell just told you a hike's basically off the table. Is that a catalyst? Is that enough to move the market higher?
It feels like it is, maybe, Josh, for this week, but I would argue you're sort of just running up to this inflation print next week, right? If we think about what the CPI prints over the last couple months have done to any sniff of a rally moving higher, it's been, okay, oh, that's not a good print. That's not a good, and we've sort of gotten that consistently over the last couple months. So to me, that's the big thing I have circled. It's not coming tomorrow and it's not coming in 2 days, but I think that inflation print seems like one of the next big drivers.
Yeah. All right, thanks, Josh. Speaking of Palantir, reporting first quarter results, and shares are rising after the company raised its forecast, although not rising by that much, interestingly. Full year revenue from the company now seen at $2.68 to $2.69 billion. So it didn't raise it by much. The estimate is for $2.68 billion. So I should say it's not as though the forecast is way above estimates here. Let's run through the first quarter numbers as well. Adjusted earnings per share at 8 cents, pretty much in line with estimates. First quarter revenue, $634 million, which is just above the $615.8 million that analysts have been anticipating. And adjusted EBITDA in the first quarter, $234.9 million, above the $204.7 million that analysts were anticipating. The shares are now taking a little bit of a hit. Initially went up after that raised sales forecast, now a little bit lower. So we'll keep on tracking it. But looking into the statement here, Josh, there was nothing that sort of stood out. The company, commercial has been a big, initially this company saw a lot of its revenue coming from government contracts, and then was trying to really beef up the commercial side of its business. It does point out here in the statement, commercial revenue was up 40% year over year to $150 million. The customer count among commercial customers was up 69%. So that's something that it is touting here. Government revenue, on the other hand, was up 16%. It's still much bigger, $335 million.
Yeah, I think the government side is interesting because kind of the tailwinds for the business ahead there. They did announce that kind of contract with the Army called Titan. Commercial's also really interesting, Julie, just because of the competitive dynamics there and how that plays out. But then obviously a big part of the story, we're just talking to Schaefer about this, is AI, AIP, that's their artificial intelligence platform, and you can expect a lot of questions on the call about just what customer demand and, of course, monetization looks like there.
Yeah, it is interesting, again, that we are not seeing a better reaction. The shares, we're going to keep on digging in. And speaking of digging in, we have an analyst that we're speaking to a little bit later on, Rishi Jaluria, about these numbers. So maybe he can shed some light on the perception here.
Well, part of it, too, remember the ramp into this print. True. It was up about 40% this year, 200% in the last 12 months. So, Rishi is great, so we're lucky to have him. Yeah. Moving on, as earnings season winds down, there is one Magnificent Seven stock left to deliver their quarterly earnings. NVIDIA, of course, is on deck to report first quarter results. That's going to be later this month. Investors are waiting to hear from the AI darling after collecting insight from several companies on their AI efforts. For more on the key trends this earnings season, let's get to Innovator Capital Management Head of Research and Investment Strategy, Tim Urbanowitz. Tim, it is good to see you. So maybe we can start there, Tim. Earnings season, just interested to get your take, Tim. What have you learned? What have been the kind of key trends, themes, takeaways for you?
Well, Josh, it's been a very strong season overall. We've seen very good growth at the index level, and a few key trends that we have been paying attention to here recently. Number one, we've seen very strong margin growth across the board, really across most sectors. Particularly, we've seen it very strong within the technology space, communication services, where companies are expanding their margins, they're growing the bottom line, which I think is very encouraging. And if you look at what we saw throughout the quarter, we had a quarter where growth remained firm and inflation really accelerated. And what we tend to see is that as inflation accelerates, you tend to see margins grow. And that's exactly what we're seeing right now. We do have to be careful moving forward. Everybody wants this inflation narrative to get under control, but that also might mean that, moving forward, you could see those margins come down a little bit. That's not our view that we're going to be in that environment. But if we are, you need to look out for that.
Tim, what's also interesting, we were just talking about Palantir as one example of the AI trade and companies that are giving more and more information about AI and how it's affecting their earnings. What do we learn in the earnings season with regard to the AI trend?
Well, Julie, when we're talking with investors right now, one of the key themes that we are continuing to reinforce is that this is not a trend that you want to fight. Companies are looking to integrate, they're looking to scale. And right now, we think it's really all about the infrastructure build out. So thinking about things like semiconductors, data center REITs, cloud companies, they're going to be critical for that integration. And even if we see a downturn, I'm not so sure that you're going to see that pullback in spending just because it is so critical for productivity longer term. So we think that theme is really important. It's been a key driver of the market throughout the first several months. We think it's going to continue to be the key driver over the next several months, specifically with that focus on AI infrastructure and building that out.
And Tim, I'm interested what you think just broadly what the next catalyst for the market is. Tim, we did get some, recently those good data points, right? So you saw that jobs report, okay, cooling but not crashing, and earnings coming in better than expected. Apple reports and pops, and Jay Powell just told you unlikely the next move is a hike for sure. Is that enough for a catalyst, Tim, to move the market higher?
Well, it's going to be interesting, Josh, and I think we're going to continue to be in this environment where investors continue to over-extrapolate information from little data points like we saw last week. No doubt that was encouraging, seeing the softening in the labor market. Wage growth started to cool a little bit. That ultimately is going to hold the keys, but we need to remember that this is just one data point. We need to see that continued trend to really get this battle under control. So what we are talking about to advisors right now that we think is probably the most critical thing in their portfolios is you have to find ways to decouple risk management needs from the reliance on interest rates coming down. You're going to continue to see big volatility in rates, as we were just talking about earlier. And that means really decoupling, separating those risk management needs from the reliance on interest rates. We're seeing a lot of clients in our world gravitate toward options-based strategies. Buffer ETFs is one example that we're seeing a big move in. And we think that makes a lot of sense, just given that you have the built-in risk management. You don't need to rely on long duration bonds. You're not relying on low volatility stocks, defensive sectors like utilities, which at the end of the day, Josh, are all beholden to interest rates having to come down. It's not what we want. You got to separate those two.
And so in other words, it sounds like not necessarily a more risk-off environment, but maybe a little bit more risk cushion or risk-averse environment than we've been seeing over the past year or so.
Yeah, well, what we're saying right now, Julie, is we want to be risk aware, right? We want to be aware to the risks out there. No doubt we're towing the line, right, between getting inflation down and the recession, right? We got to walk that straight and narrow path. But our base case view is that you're going to continue to see a world where economic growth remains firm and inflation remains firm. And that is a world that I think you can continue to see equities do very well in overall. Talked about on the front end, inflation goes up, you tend to see margins go up. Growth remains firm, that tends to drive the top line. And at the end of the day, you can look at all the economic data you want, but earnings are what drive stock prices over the long run. So we think that's actually pretty favorable for equities here moving forward.
Tim, I'm just curious too, switching gears a bit here, how you think about geopolitics. I ask because we are seeing these headlines drop. Israel did begin hitting targets in the southern Gazan city of Rafah, Tim. I'm just interested, as a strategist, you're talking to clients, how do you just think through these kind of geopolitical dynamics?
Yeah, well, we think about how we manage that risk. And obviously at the index level, buffer ETFs we continue to see as a very viable solution to help manage that risk. I also see we're talking to clients a lot about integrating energy into their portfolios. Energy is one of those sectors right now, Josh, that's trading at about a 40% discount to the broad market. It's very cheap. And it also offers a very nice hedge to a lot of those geopolitical tensions. And by the way, a lot of those macro tensions that we were talking about earlier, if you continue to see that reacceleration in inflation, it's obviously something that no one can predict. So it's important to have that built-in risk management in place and also look to those pockets of the market that are underappreciated, but all for nice defense.
Tim, thanks a lot. Good to see you.
Great to see you as well, Julie.
All right, let us get a little bit of a recap of today's action, sponsored by Tasty Trade. As we've been mentioning, that best 3 days for the S&P 500 going back to the beginning of the year here. The Dow and the Russell 2000 are actually up for 4 straight days. And we've got the Dow with its highest close since April 5th, the Nasdaq 100 and the S&P 500 at their highest close since April 11th. So we have not seen this sort of upward momentum in a little while here, which is interesting. Also, some of the other streaks that Jared Blickery shared with us here. Amazon, Alphabet, Meta, and Microsoft up for 4 days in a row, which is interesting also and catches my eye. Josh?
And coming up, more coverage from the Milken Conference. We're going to hear from Pinterest CEO Bill Ready on the other side of this break.
Pinterest is on, well, a little bit of a hot streak that I don't think the market really has caught on just yet. Let's talk to Pinterest CEO Bill Ready. Bill, good to see you at the Milken Conference. I've seen you all around the world. Good to see you in California.
Yeah, good to see you again.
7 straight quarters of what? MAU?
Accelerating user growth, yeah.
How?
So well, it's a fantastic quarter, but it's really the culmination of initiatives that we've been putting in place over the course of the last nearly 2 years. And we hit an all-time high in users, 518 million monthly active users, and we've accelerated 7 quarters in a row on users across every generation and across every geography. But where we're really winning is with Gen Z. Gen Z is now 40% of the users on our platform and our fastest growing demographic.
That's what, people in their late 20s?
Yeah, it's
what are they doing on Pinterest?
It spans, sort of teenagers through, college graduates and sort of folks early in their career. But they're coming for two primary reasons. One, we've really improved the actionability on the platform. Pinterest is where Gen Z goes to shop. And so Pinterest had previously been great at window shopping, but you couldn't really get to the things that you found. Over the last 2 years, we've really been opening the stores, making it really easy for users to connect to the things that they find on Pinterest. And that led to us more than doubling the number of clicks we sent to advertisers year on year in Q4 and in Q1. So that actionability and shoppability is really resonating, but then positivity is really resonating as well. We've really invested in making Pinterest a more positive alternative to traditional social media. And when you ask Gen Z, they will tell you that they see Pinterest as an oasis away from the toxicity that they see on much of the rest of social media, and that's cutting through. And it's a great example of doing well by doing good.
I want to get back to that because I know that that's something you've been very focused on literally since you started at Pinterest.
That's right.
When you talk about shoppability though, is that the power of your AI, any new AI you're releasing behind the scenes to help people shop on the platform?
Yeah, absolutely. So AI has been a massive tailwind for us. And so, we've done a few things. One, we really lean heavily into large language models, next-gen AI, like GPU serving, things like that. We now use models that are 100 times larger than the models that we were using a couple years ago. That led to roughly a 10 percentage point improvement in relevancy of the recommendations we make to our users. But we've also been doing things to design our product to create great signal for that AI. So for example, we've really leaned into human curation at scale. So it's not just that users come to Pinterest to shop, they come to Pinterest and curate and put together outfits, put together room designs. And so when those users say, oh, I'd put this handbag with this dress and this pair of shoes, or to put together a room in this aesthetic, I'd choose this lamp and this sofa and this rug, that gives us really great signal to make better and better recommendations to our users by training the AI on that really unique signal. And importantly, it's helping users to do things that help them take action in their real life, not just keep them glued to a screen, but actually make their life in the real world better as well.
I'll put this question to you. So Warren Buffett's annual shareholder meeting, he sounded concerned on an AI after someone, I guess, made a video of him talking. Now I asked IBM CEO, does he share those concerns? He says, no, they're fantastic. What's your views?
I think like any technology, the AI is neither good nor bad, but it can be used for good or bad. And so I think it's a totally appropriate conversation to be talking about what could the harms be and how do you avoid those harms. And on our side of it, we're trying to prove that you can use the AI for good. So we've done things like inclusive AI. We've launched features like inclusive AI that we're doing that creates diversity by default in our feeds. We're tuning the AI for positivity. So roughly a year ago, when we saw each other last at the Cannes Festival, we launched the Inspired Internet Pledge, where we committed to measuring emotional well-being outcomes on our platform. And so we're tuning the AI to serve more things that help users come away feeling better about themselves. And so body positivity is an example of that, where we've launched body type AI so that people are able to see a more representative set. They can choose the body type that represents them best, see a more representative set of not just what the average fashion model looks like, but what they look like and what real people look like. We've done the same thing with like skin tone filters and hair pattern filters. And so these are examples where you can use the AI for good. And that's what we've been focused on, is like, how do you use AI for good? And you can also use AI to avoid some of the bad things as well, where we've used AI a lot to get bad actors off the platform and build safety features through AI. So again, AI is neither good nor bad. Like any technology can be used for either, so we're focused on how do we use it for good, and how do we also use it to avoid the harms that could be possible.
You and I in the past have talked about TikTok, what a ban might be. It is what it is. But is the best possible thing that could happen to the internet is something like this gets banned and doesn't exist in the US, so we can go back to focusing on other things and getting life done?
What I would say, rather than comment on any one platform, we're not sitting back hoping for the demise of other platforms. We have accelerated with Gen Z because we're doing something really unique in the world of social media. And, it's on two fronts. Users come to Pinterest with intent. We're not an entertainment-based platform. Most of social media is entertainment-based. The user's in a lean-back entertainment consumption mode. users come to Pinterest with intent and purpose, whether it's to shop or to make or to do or to buy. They're coming with some intent and purpose, and we're helping them fulfill that intent and purpose. So that actionability is very different than much of the rest of social media. And the positivity that we're investing in around making sure that we tune the AI for positivity, tuning for emotional well-being outcomes and more positive emotional well-being outcomes. You hear it from Gen Z users. They will tell you they come to Pinterest because they see it as an oasis away from the toxicity of the rest of social media. So again, is it understandable that regulators are going to, pay attention? Governments and regulators will look and pay attention if they think there are potential harms. That totally makes sense. But we're not sitting around waiting for government action. We're focused on avoiding those harms on our platform, tuning for positivity, and giving Gen Z something that's really great, that's different from the rest of social media.
Before I let you go, tell me if I have this somewhat right. So you have a deal with or a partnership with Amazon and Google. Do investors, are they underappreciating how those two partnerships will change your cash flow and your earnings over the next few years?
Well, what I would say is, I think you are seeing, the acceleration in our ad business really cutting through with advertisers. First and foremost, do we perform for advertisers? We more than doubled the number of clicks we sent to advertisers in Q4, and we did it again in Q1 and actually accelerated even further.
Is that because of Amazon?
It is really because of the actionability that we're bringing to the platform, and that's through a combination of efforts. A lot of it is retailers coming to us directly, but then we've also, as you noted, augmented that first-party demand on our platform with third-party demand coming from Amazon, who we've been working with for coming up on a year. Google we added more recently for international markets.
Okay.
And so that is helping to bring more shoppable, actionable inventory onto the platform, but it really is a composite effect. And what I would say is that when you step back from it all, Pinterest is firing on all cylinders. If you look at the initiatives I laid out when I came in nearly 2 years ago, that we went through at our Investor Day last September, our strength has been broad-based. We roughly doubled our revenue growth rate from Q4 to Q1. We doubled it from H1 to H2 last year. We doubled again from Q4 to Q1. And we've accelerated user growth in every geography, with every generation. And so it is really all the initiatives we've laid out around actionability and positivity, better performance for advertisers. All those initiatives are hitting and performing well, and so the strength is broad-based.
Oh, turnaround continues at Pinterest. Pinterest CEO Bill Ready, good to see you. We'll see you at Cannes. Hopefully,
look forward to it.
No sunburn for both of us this year.
Absolutely.
Guys, back to you.
Time now for what to watch Tuesday, May 7th. Starting off on the earnings front, companies reporting tomorrow include Disney, BP, and UBS. Disney announcing its second quarter results before the bell. Its first report since CEO Bob Iger defeated activist investor Nelson Peltz in a contentious proxy battle. Analysts expecting parks to be a bright spot for the House of Mouse, and streaming is also expected to get a boost from price hikes.
As earnings season rolls on, we'll see more earnings from Toast, Rivian, and Lyft. The rideshare service reporting its first quarter results after the bell. Active rider growth is something analysts will keep their eye on during the earnings call. Top-line gains expected to trail the company's rideshare competitor, Uber, which is reporting on Wednesday.
And finally, taking a look at the Fed. Minneapolis Fed President Neel Kashkari scheduled to speak tomorrow. Is coming after today's commentary from Fed President Tom Barkin, saying that he's optimistic that today's restrictive rates can bring inflation down.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side.
Shares of Palantir sliding after hours after reporting first quarter earnings, despite the company beating on the top line and raising its full year guidance. For more, we're bringing in now Rishi Jaluria, software equity analyst at RBC Capital Markets. Rishi, it is always great to have you on the show. So let's walk through this, Rishi. So Palantir reports they beat sales estimates, it looks like, for Q1, Rishi. They raised their forecast for annual revenue. Initial pop, but now we're down here about 9% in the after hours. What is going on here, Rishi? Give me your take.
Yeah, absolutely. And Josh, thanks so much for having me. Always a pleasure to speak to you. I would say it's a combination of a couple things, right? It's high expectations because this has become a hyped, or in my opinion, overhyped generative AI, beneficiary company, and we can get into that in a second. You saw the stock was up 8% on the day today, heading into earnings. And then, they put up results that are a beat and raise, but I think that was priced into the stock. And then at the same time, you see U.S. commercial decelerating pretty big. Last quarter, they put up 70% U.S. commercial growth. Now they're growing U.S. commercial 40%. I think it's a combination of those, as well as some other things that's leading the stock down about 9% in the aftermarket.
Well, Rishi, it's Julie here. Why is that commercial growth slowing? Is it just a matter of that they couldn't keep up that same pace? Or is there some issue with execution? Or is it end market demand? What's going on?
Yeah, I think it's a couple things, right? Number one is the compare itself just gets a little tougher. I think that 70% commercial number that they posted last quarter was maybe boosted by just a very, very easy compare and some one-time impacts. And so that's piece number one. I think piece number two, and we'll see how this plays out over the coming quarters, but when we talk to actual technologists who are deep into AI, deep into ML, who know more about this topic than I could ever hope to over my life, they are expressing skepticism around Palantir and especially around AIP and whether they are what they say they are from an AI perspective. And maybe there's a little bit of that showing up in the U.S. commercial numbers and why we're seeing that slowdown as well.
What about, Rishi, this company's boot camps where they get customers, kind of up and running fast with their AI software? Smart strategy, in your opinion?
I think it is, but look, I would again put a little bit of skepticism around that bootcamp strategy. I think number one, remember Palantir is very heavy customized software, right? I estimated more than 30% of their business is actually professional services and outsourced data science rather than actual true software. So I don't know that it's even the right fit for something like a bootcamp. And even then, if we really think about bootcamp customers, these are people who say, okay, come and figure out some of my problems and give me a use case. But it doesn't go from there to a customer becoming a multi-million-dollar Palantir customer overnight, which is how they make it sound on earnings calls. But in reality, a lot of times, those bootcamp customers might do multiple boot camps, or they might turn into a pilot customer over time. It's not nearly the game changer to go to market that I think they claim it to be.
Rishi, so obviously you're not a fan. You've got an underperform on the shares here. We see it coming back to earth today, but the market has not been on your side thus far this year. The stock has rallied. There definitely are a lot of Palantir buyers out there. Where do you think this sort of disconnect lies between that perception of Palantir as an AI winner and what you're saying, which is that in truth, it might not be?
Yeah, I think it comes down to that perception around exactly what is Palantir and exactly what is AIP, because there is no way the valuation of Palantir stock at 25 times forward revenue is supported by 20% growth and the margins that they're putting up. That's just not possible if you compare it to what other things in software are trading. What I think it comes down to is Palantir messages that they are this cutting-edge generative AI company. They message a lot around AIP and boot camps, and I think very deliberately target retail investors. And look, everyone wants to play the AI game, and don't get me wrong, I'm a huge believer in AI and especially generative AI's technology. I think it is going to change society as we know it. I just don't think Palantir is that cutting-edge generative AI company that they claim it to be. I think it is a good data pipeline. It is a good data ontology company. I'm not saying it's not a useful company, but it is not what they claim it is. And I would say to any investor that really wants to play this AI trend, go buy Microsoft. They are doing a lot more when it comes to generative AI. Plus, they have that very deep partnership with OpenAI, which to me is one of the most important companies in the world today. I think Microsoft is a much better way to play the AI wave than Palantir.
And Palantir, Rishi, we're talking AI, their commercial business, but of course, the company's roots are in government sales. I'm just interested for that business segment, Rishi. Looking ahead, what do you see? Puts and takes. Any tailwinds that you see ahead?
I think there's really some interesting puts and takes here, right? Because what we've picked up in our checks and our conversations is that government agencies are actually looking to reduce their dependency on Palantir and maybe multi-sourcing, use multiple vendors, which is, what we saw in the UK with the NHS deal, where they actually ended up using a number of different vendors instead of Palantir, and the deal ended up being a lot smaller for Palantir than expected. And so I think there actually could be a little bit of mixed results in the government business over the next couple of years as a result of this. I will also say, the government business is probably the stickier, better quality business for Palantir, but it's not a high growth business. And I think that's why they don't emphasize it nearly as much as they do the US commercial business.
Rishi, we'll get you chatting here on this. Another name in your coverage universe I know is Salesforce, CRM, reporting in a few weeks, I think, Rishi. Obviously, a lot of headlines there about M&A. Maybe it was happening, then it wasn't. What are you expecting to hear from Mark Benioff, Rishi?
Yeah, look, I don't expect that they're going to comment on the Informatica buyout rumors. I will say I'm actually breathing a sigh of relief as a Salesforce bull that the Informatica deal isn't going through, because I think there are better things they can do with that money, including buying back their own stock or juicing up the dividend. What I expect out of Mark Benioff and out of Salesforce's results is I think they're going to talk a lot about Data Cloud and some of the success they're having at the data layer, which is a new muscle for Salesforce. But we've been really impressed with the numbers and momentum that we've seen out of Data Cloud, and look for kind of more color around that, more color around how their efforts to integrate their multiple clouds, including Marketing Cloud and Commerce Cloud, onto the same core platform are going, as well as just how we can see the future margin trajectory going from here. We've seen some very impressive margin expansion coming from Salesforce over the past year and a half. I think there's still a long way to go on margins to get them in line with best-in-class software companies like Microsoft and Adobe. And so I think there's a lot that investors can be excited about with Salesforce, and looking forward to hearing a lot of that color on that earnings call.
Well, Rishi, maybe we'll have the chance to catch up again when they report the numbers. Thanks so much for your perspective here. Really helpful.
Thank you so much.
Well, EV startup Lucid results are out and the stock is sinking. We're going to dive deeper into those numbers on the other side of the break.
Lucid shares dropping after delivering first quarter results. Yahoo Finance's Praz Subramanian is here with the very latest. Praz.
Yeah, stock not doing well right now, and they had a revenue beat here, a nice one actually, but wider than expected loss, profit loss, adjusted EBITDA loss wider than expected too. So some concern there about profitability. We already saw they had a pretty decent quarter in terms of deliveries, and they're still standing by their 9,000 production guidance for the year, and then also their Gravity SUVs on track. So some good news that they raised some money in the quarter too, but the big question is, what's the status for the next product, and also can they keep kind of going to the well of the PIF, the private public investment fund, to keep getting money for the company? It's still losing enough money that only has enough runway to about Q2 of 2025 at the moment.
And what do we know about sort of deliveries or projections or how things are going to go for them the rest of the year in terms of what demand looks like?
I mean, they claim that they're going to get 9,000 delivered this year, and then
they didn't shift that, Praz.
Yeah, they didn't shift that, and they had about 1,900 in Q1. So you can do the math, and it's going to be a little bit 2,500-ish per quarter. Less than 10,000 a year for a car that starts at $69,000. Wow. I mean, that's a high price, high premium product there. And then the question is, will the scale effects make a difference, and can they actually start making money on these cars? And I think that's the problem. I think that investors are seeing is where does it turn where the cars make money for the company? And
that seems to be kind of the issue for any EV maker, right? Or not even just pure EV makers, even the big automakers making money on EVs. Right. Is just something that it seems like mostly Tesla has cracked.
Yeah.
And the rest have not.
They're all waiting for their second generation EVs that are supposedly be cheaper to make and things like that. But I think right now, in the here and now for Lucid, they're still ramping up their first generation EVs. Right. I think the whole investment thesis is that Gravity SUV, when that comes out, is that going to sell like hotcakes for them? And then their next mid-sized car is 2026. But the question is, how do you get to 2026? We're still 2 years away.
Yeah, and the shares falling, as we mentioned after our session. It's not as though they were rallying into the report. They've been rallying in recent days, but they're down about 28% this year so far. So expectations maybe we're creeping up a little. The stock rose 9.5% today.
Yeah, crazy options activity. So I want to see what CEO Peter Rollins has to say today in the call. We'll see if he addresses those concerns that you're talking about. Potentially there was thought that they might push up some of these releases, but that wasn't the case so far.
We'll see what it says. Thanks so much, Pras. Another company out with numbers, Hims and Hers, and those shares are up some 11% following an earnings beat for the first quarter. Revenue up 46% year over year to $278.2 million. That topped analyst estimates. Second quarter and full year revenue forecasts also came in well above expectations, and the company sees the second quarter coming in between $292 million and $297 million. The estimate there was for $288. For the full year, the forecast here, $1.2 to $1.23 billion. The company CFO said, quote, "We've updated our full year outlook to reflect the ongoing business momentum and efficiency improvements we are experiencing." Coming up, we're heading to Main Street with a panel of business owners as part of our Small Business Week on Yahoo Finance. Stay tuned.
Small business optimism is at its lowest level since 2012, according to the National Federation of Independent Business. The optimism decrease in March comes as inflation remains a top concern. As part of Yahoo Finance's Small Business Big Opportunities Week, we're speaking with small businesses from across different industries here in the U.S. And joining us now to discuss is Sprecher Brewing CEO Sharad Chadha, the Tiny Tassel founder Mimi Striplin, and Carla's Fresh Market founder Ariel Ilunga. Welcome to you all. The reason I'm excited to talk to you all is because, listen, we talk to a lot of smart economists on this show and strategists, and we crunch a lot of economic data. And if you just looked at the data, you would look at an American economy right now that seems decent, that does seem sturdy, but you all have a unique perspective because you got boots on the ground. Maybe I'll start there, Sharad, with you, and we can go around the horn. I'm interested, Sharad, just what does business look like right now? What does demand look like now, Sharad, in your business?
Josh, thank you so much, and thanks for having me. We are a craft brewery. We're the oldest craft brewery in Wisconsin, Sprecher Brewery, since Prohibition. We've got about 150 employees now, so we are boots on the ground. Supply chain is still disrupted. Inflation is still giving us a lot of pain, but we are growing. We have, in the last 3 to 4 years since we took over, about triple the size of the company from 50 to 150 employees, but it's been very challenging. Inflation especially has hurt us a lot. The cost of packaging, glass, honey, sugar, all our ingredients is up more than 50%. Gas is up, and that's hurting us. We have full health insurance and benefits for our employees. That's gone up a lot. Finding people is still not easy. Interest rates have gone up to 8.5% from 3.5%. So for a small business, it's a big struggle. We're grinding it out, though. We're hustling, and we're trying to do it and grow within that. Unfortunately, the demand is still there. We're pushing hard. We've gone from a few states now to all 50 states. We just exported to Canada and Australia and hope to keep that going, but it's not been easy.
Mimi, I want to bring you in here next. So Sharad, I think, is saying, listen, there are some pain points there, but they're growing. The demand is there. Is that what you're seeing in your business, Mimi? And maybe also describe to us what you all do.
Yes. Hi, Josh. We are a boutique here in Charleston, South Carolina, and we're actually the only Black and Asian-owned women's boutique on the peninsula of Charleston, South Carolina. And we design and make jewelry, clothing, accessories, and really accessible, fun, joyful styles. And we've seen a decline in the last year in sales online and at our brick and mortar store. And we've also seen the struggle of finding great team members, of being able to compete with wages and benefits and pay them well. And we have just really struggled to engage with our customers again without throwing lots of money at ad dollars and different marketing techniques that haven't really shown a great benefit in the past. So we're trying to work smarter and really, really allocate our funds where we can see a ROI immediately, because this is the first year that we have had to really crunch the numbers and really, really worry about cash flow. And we don't want to have to continue laying off team members. We want to continue building this brand and empowering our team and creating a great workspace, not just sell great products, but we're hoping to start seeing an increase in sales in person and online as the summer season kicks off here in Charleston.
Ariel, let's get you in the conversation too. Mimi's talking about kind of working smarter there in Charleston. What are the demand trends you're seeing for your business?
Hi there. Thanks for having me. Carlos Fresh Market is a very new business. We've been open for 5 months. So we've opened up on the other side of the pandemic, on the other side of the supply chain issues. So all we really know is the landscape of today. We're full service, coffee, produce-driven environment. We have a natural wine bottle shop, grab and go items. And I'm really focused on just customer acquisition right now and providing a warm and inviting environment and really responding to the customer's needs. The day I opened was the day I released the dream, and I'm really focused on bringing in items that the customers want to purchase.
Sharad, back to you. I'm interested in this question of inflation, which you kind of called out as a real headwind. How, Sharad, as a small business, are you sort of navigating that challenge, Sharad? What levers are you pulling? Are you able to raise prices, for example?
Yeah, Josh, that's a great question. The challenge is, for a small business, it's not easy. Although we are the oldest craft brewery, we make the #1 root beer in America per New York Times and blind taste tests by others. It's still hard when you go to Costco or Menards, push and to our consumers. We're not Coke and Pepsi, so it's not so easy for us to raise our prices. So we have to absorb a lot of those costs, and that squeezes our margin and our cash position, as one of your guests said. And that's a very, very precarious, difficult situation. We got to do payroll every 2 weeks. We have to make line time and have the supply chain ready with warehousing and sales. And it's been a very challenging, pushing a boulder uphill for a small business, and it's not been easy.
Mimi, I'm interested too, and they're in Charleston, which I'm jealous, one of my favorite cities in the country. We got that big jobs report last week, Mimi, kind of, it showed cooling, not crashing, but cooling. I'm just interested in what you all are seeing. Are you guys hiring right now in your business?
We're not able to hire at this point. We're starting to see a demand and a need for more team members in our retail shop, but the cash flow is just not there to make a data-driven decision to bring on more team members. And of course, there's always that fine line of, if you bring on another team member, will that help to create more revenue and have more hands on deck? And right now we're really facing tough decisions of, do we make our current payroll or buy our supplies and inventory, or do we invest in a new team member?
And Ariel, I'm also curious how you on your business, how do you reach new potential customers right now, Ariel? Are you having to spend more on marketing, advertising? How are you going about it?
I'm definitely riding the tailwind of being a new business and just having a compelling story. So I had a fair amount of press in the beginning when this store launched. And I just was deeply rooted in several communities here in LA, which has sort of propelled the business. I ran farmers markets for 5 years, so definitely rooted in a foodie community. I'm a native LA person. And so I'm just riding those tailwinds, and because it's early days, they seem to be getting folks in the door. I, of course, need to double that to keep going, and that's why we're, again, focusing on the customer experience. But to echo what Sharad said, I feel what he's saying completely. I think consumers are so used to paying a certain price for food, and now the veil is being lifted on the true cost of a lot of things, from Uber to DoorDash to food. And it's, we're in an education process with customers and letting them know that this chicken is not, all chicken isn't created equal. And, there's been some pushback on that. And so there's a lot of deep education and with our customers about, what this orange means versus another orange.
Sharad, Mimi, Ariel, thank you all for joining the show today. Running a small business, no easy thing. It takes a lot of guts and a lot of grit. Thanks so much for joining us.
Thank you.
Thank you, Josh. Thanks, everyone.
Thank you.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.